Hi, I'm Steve from Clearly Training, and you're watching our Finance for Non-Finance People series, and this is the last one, the 6th episode in our Finance for Non-Finance People series. And this one is a roundup thing on other accounting stuff, other things I think it might be useful for you to know about. So included in here, I've got management accounts, first of all. Secondly, I've got something on budgeting. And thirdly, I've got something on EBITDA, something called EBITDA. We'll come back to what that means later. Okay, so budgeting and management accounts. In those two areas, I'll be giving you a brief introduction to what budgeting and management accounts are all about and what that means, what a budget is, what management accounts are, and so on. I have mentioned these things on previous videos. And also, you might like to know we have another video series that looks in a bit more depth at things like budgets and management accounts and other things. So there's an advanced series of finance for non-finance managers with more detail in these areas. So let's make a start on them. First of all, we're going to have a look at management accounts. So what are management accounts? Why do we have them? What are they all about? Well, management accounts are internal. They're internal accounts that are produced by organizations that want to track how well they're doing. And when I say how well they're doing, I'm talking about their performance, and therefore I'm talking about their profit and loss account. Now, just be careful here because there's no technical definition of what management accounts are. But most organizations, when they talk about management accounts, they will mean an internal profit and loss account, which will look at how the organization has performed, let's say, over a month. So the most common type of management accounts will be a monthly profit and loss account produced internally by the organization. It won't have any set legal format, but it will usually be a profit and loss account or an excerpt from the profit and loss account, and it will be in the same format that we've looked at for P&L accounts. It will have sales at the top and then the costs below that. Now, just be careful here, because if you're a manager who's running an operating division that has its own income and expenditure, so it's what we might call a profit center, so it has both income and expenditure under the control of you as manager, then you will see something that you recognize as a full profit and loss account. So it will start with the revenue and it will have the cost deducted and it will show you the profit. However, if you're a manager who's just running what we call a cost center, so you don't look after income, you just look after costs, then you'll just see an excerpt from the profit and loss account, which will show the things that you look after, the cost categories that you look after. So it won't be a full profit and loss account. It'll just be your excerpt of that. So management accounts are an internal document. The management accounts for the organization will show the profit and loss account for the organization for the period that you're looking at. And if you're a manager, you will see the bit of that you're responsible for. So management accounts are, as the term suggests, they're sent to the managers of the organization, all different levels of manager, right from the board down to the senior managers, the middle managers, the junior managers, and even supervisors. It depends how your organization is structured. There's no set format, as I've already said. You can have them in whatever format you like. Often in the management accounts, your actual performance will be compared to the budget performance that was set for you at the beginning of the year. And we'll be talking more about that in the next slide. They tend to contain, as I said before, the profit and loss account or excerpts, parts of it. What will also be found in the profit and loss account will be other things. Other organizations, more sophisticated organizations, will like to put other things in their management accounts, things like key performance indicators or KPIs. So maybe the number of key customers that we've gained in the month, or the number of key customers that we've lost in the month, maybe the level of staff turnover in the month, maybe the level of staff recruitment in the month. Lots of other things that might be non-financial may appear as part of that report. There may also be a commentary in that report, somebody doing a written narrative, maybe the finance team, maybe the managers themselves having to do a commentary on the numbers in the management accounts. So you can find all sorts of information in the management accounts, but at the center of them usually will be the profit and loss account, which will show the performance for the latest period under review. So that's the management accounts. Let's move on and have a look at the budget. What's a budget? What are budgets? Well, budgets are a prediction. They're a prediction. Usually we budget for a year. So what will happen? Let me give you an example. Let's say our business is run on calendar years. Our business has a financial year that starts on the 1st of January and ends on the 31st of December. So what will happen, let's say, in the current year is sometime in the second half of the year, maybe in August, September, October. It depends how big the company is and how much effort it's going to take to produce this budget. But somewhere, let's say in October, in my fictional company, sometime in October, the company will start to think about the next financial year. And they will start to think about what's our prediction of the profit and loss account and balance sheet and cash flow for the next financial year. And they will start to put together a budget. And it depends on how the organization functions, but often what the organizations will do is they will ask their senior managers and sometimes the junior managers to contribute to this process. And it might take a couple of months, but by the beginning of December, let's say, we should have a good idea of the prediction for next year. And what we will do is we'll put together a prediction of what next year is going to look like. And the most important part of that prediction, or budget as it's known, is the following year's profit and loss account prediction. So our budget, and when people talk about the budget, they usually mean the budgeted profit and loss account. So we'll put that together at the end of the previous year, and it'll be a prediction for the next year, how we're going to perform in the next year. Now, the reason we prepare that is because once next year gets started, once we get to the end of January next year, what we can do then is we can compare the actual results for January in the management accounts, the actual profit and loss account for January, with the budget that we created in the previous year for January. Yeah, and we can see how well we've performed. Yeah, so it's a way of looking at how close we got to our predictions. And if we differ from our predictions, the accountants use the term variance. If we're different to our prediction, that difference is called a variance as opposed to a difference. That's just a term that accountants use. Our budgets are also a good way of briefing our investors. So if we're a very large company and we have investors, shareholders who aren't directly involved in the management of the company, what the management of the company, the directors, the board will have to do is they will have to tell the shareholders what they think is going to happen next year. And the shareholders will be particularly interested in what next year's profit and loss account will look like. So what happens is at the end of a year, we go to our investors and we say, look, this is what we think next year is going to look like. And we can only do that if we prepared a formal budget. I mentioned a couple of points ago that if we have a budget, then when we start the year that the budget is predicting, we can get to the end of the first month, let's say January, and we can compare the actual performance against the budget performance. And you know what? As I said before, there might sometimes be differences. There's often differences, and we call those variances. And you know what? Sometimes the differences might be because we've made an error when we're doing our management accounts. Yeah, and that does happen. And so having a budget is a good benchmark. It can help us to spot when we've made errors. And our budgets are therefore a means of control, because once we've got a budget, we can monitor the performance of the managers and we can monitor the performance of the organization, spotting errors, making sure managers keep on track with what we expect from them, making sure that our shareholders are well briefed. So it's a method of controlling our organization. I've just put down there at the bottom something very, very, very important, that when people refer to the budget, they usually mean the budgeted profit and loss account. We will usually, as a large organization in particular, do a budgeted balance sheet and, very importantly, a budgeted cash flow. But when people use the term the budget, they often, almost always mean the budgeted profit and loss account. Just bear that in mind. Okay, so that's the budget. Good introduction to what a budget is all about. And there's a big relationship between the budget and the management accounts. Once we've got a budget, we can track the performance of the organization by producing management accounts and comparing the management accounts for each month against the budget for each month. Okay, that's how the two fit together. Now, onto a separate topic of EBITDA. Okay, EBITDA, what's this all about? Well, it's an acronym. It's an acronym, EBITDA, EBITDA. We already came across the idea of EBIT, earnings before interest and tax, when we looked at the profit and loss account. The earnings before interest and tax also has the name operating profit in the profit and loss account. EBITDA is the earnings before deducting interest, tax, and depreciation of tangible fixed assets, of course, and amortization of intangible fixed assets. So EBITDA, earnings before interest, tax, depreciation, and amortization. So it's a measure of an organization's performance, like EBIT is. Operating profit is a measure of an organization's performance, but it's a measure before deducting interest and tax. And this measure has been introduced a number of years ago, and it's become increasingly important. So most organizations, particularly large ones, look at their EBITDA as a means of performance. So we have to ask ourselves, why is this measure there? What does it mean? Why has it arisen? Well, originally, remember, management accounts, something we saw a few slides ago, the management accounts are sent to the managers. Now, imagine if you were a manager in an organization, you were sent a set of management accounts, and let's say you were running a profit center. So that means you have a set of management accounts that has income and all the expenditure in it, and it's sent to you as a manager. And the idea of sending it to you is to say, look, these are the things that you as a manager can control. Now, imagine getting that set of management accounts, and one of the lines in there is a depreciation charge. Now, it's a fact that most managers, unless they're extremely senior or on the board of directors, most managers in most organizations have no ability to purchase fixed assets without authorization. And those same managers, they never decide what the depreciation policy is on those fixed assets. So imagine how frustrating it is to get a set of management accounts with a figure in there that you have no control over, that depreciation figure. Or, if you had any intangible fixed assets, an amortization figure as well. You've got no control over those figures, and yet they're in your management accounts. So some academic came up with the idea, why don't we send managers a set of management accounts that doesn't show the depreciation in? So it just shows the income and the expenses that they can control. And then instead of showing the operating profit at the bottom of that management account, we're showing the operating profit before deducting depreciation and amortization. Oh, let's call that figure at the bottom EBITDA. Earnings before interest and tax and depreciation and amortization has been deducted. Because a manager doesn't control interest, doesn't control tax, doesn't control depreciation, doesn't control amortization, doesn't control those four things. So let's send them a set of management accounts that doesn't include those four things. And that's where the idea of reporting EBITDA as a measure of success came from. Okay. So let's have a look on my overview slide, how this might look. Okay. So if you look at your profit and loss account or income statement, we've already seen this slide, but I'm just going to adjust it slightly. You start with your revenue, you deduct your direct costs or cost of sales. Good little revision exercise this. Then you get your gross profit. Then you deduct your overheads. I'm leaving a bit of a gap here on purpose. And you get your operating profit. Operating profit, also known as, remember, EBIT, earnings before interest and tax, EBIT. Okay. Now remember, in your direct costs, you've got any depreciation that relates to direct costs. In your overheads, you've got any depreciation of assets that are used in the overheads of the business. Yeah? Okay. I'll just put in there for completeness the interest and tax and the net profit at the bottom. Yeah? Now, EBITDA. Put that in as a green box so you can see it clearly. EBITDA is the earnings before interest and tax and depreciation and amortization. So what you're effectively doing when you're creating the EBITDA line is you're taking the depreciation out of your direct costs, taking your depreciation out of your overheads, putting it in a separate line below EBITDA, and then we've effectively inserted an extra subtotal in our profit and loss account. Yeah, so we've got revenue, less direct costs, excluding depreciation. There's no depreciation in those direct costs. Then that gives us the gross profit before deducting depreciation. Then we deduct our overheads, but that's overheads excluding any depreciation or amortization. Yeah. And if we deduct direct costs and overheads excluding depreciation from our revenue, we get this EBITDA line. EBITDA, the profit before deducting depreciation and amortization. And then we put depreciation in a separate category and then we create the operating profit and so on. So everything's still in there. We've just rejigged it a little bit so you can see where the EBITDA subtotal would come. By the way, there's no legal requirement to show EBITDA on your profit and loss account. This is something that companies do internally. They show that EBITDA line there, and they usually show it to their managers so their managers can assess how they're doing and the things that they control. So there you go. That's a brief explanation of what EBITDA is all about, and lots of companies use it, and everybody uses the acronym. Very few people know what it means, by the way. So, you know, if you've got a handle on that, then you're one up on many people within your organization. I can guarantee that. Okay, there you go. Let's move on now. Let's just check our understanding. So only one question there. What does EBITDA tell us? Well, EBITDA tells us what the profit was before deducting depreciation, amortization, interest, and tax. So it's very simple. It's answer number one. There are lots of other things we could say about EBITDA, but those other things aren't numbers 2, 3, or 4. The answer is answer number one there. I hope you got that. And I hope you understood this brief, very brief video on other accounting stuff, management accounts, budgets, and EBITDA. And, you know, they're all linked together. So that's the end of our series. You've seen the 6 videos on finance for non-finance people. I hope you, should I say, enjoyed them, maybe not enjoy them, but I hope you got a lot out of them. I hope you have a good basic fundamental understanding of finance for you, the non-finance person. And maybe you might want to go on and watch our video series on advanced finance for non-finance people and get a little bit more depth and detail and look at some other areas. But that's all for now. Thank you very much for listening. I'm Steve from Clearly Training, and goodbye.